Our next guest is Adrian Day of Adrian Day Asset Management. He's no stranger to Kitco News. Adrian, good to be back with you. I'd have to say, I think the Cayman Islands is a better gig than PDAC in Toronto.
Oh, I absolutely agree with you.
A little warmer, a little warmer.
Yeah.
So Adrian, the last time we spoke was in May. And you were saying how the mining companies really needed to get their act together. And we'll get into that in a second. But first, let's talk gold. And you were also saying at the time how you felt the fundamentals remain constructive for the metal.
Right.
How does Adrian Day feel this November?
Well, I mean, clearly I've been wrong on the direction of gold over the last several months. The biggest factor affecting gold, as we all know, has been the dollar.
Right.
And the dollar has strengthened, both because of geopolitical risk, which makes people tend to head to the safe asset, and also because of the tapering in the U.S., which and the expectation, shall we say, mild expectation that interest rates are going to rise at some point. Now, I think that the expectations are totally overblown in the sense that monetary policy in the U.S. remains extremely easy. They're not going to raise real interest rates for the foreseeable future. And monetary policy is also extremely soft, weak around the world. So you have easy money pretty much everywhere. And the Fed has simply scaled back or stopped its additional buying, but there's no thought of shrinking the Fed balance sheet.
Now, do you think the QE that we'll soon see in Europe and are seeing in Japan will have the same impact on gold that QE in the US had?
Well, the unfortunate thing is that the easy money, the particularly easy money in Japan and Europe, has of course hurt their own currencies, which has made the dollar go up. So in a perverse way, the things that should help gold have actually hurt gold, because the US is the only exception, if you like. But I think the market will realize 6 months from now, whatever, the market will realize the monetary policy in the US remains easy.
But are you looking at a strong dollar? Do you see this dollar rally continuing, Adrian?
You know, it's difficult. I think the dollar's, I don't think we're going to see much more out of a dollar. In other words, I don't think the euro in particular is going to get much weaker. But I honestly can't see a particular impetus for the dollar to weaken in the near term.
Okay, so you're still liking gold?
I still like gold, yes.
Okay. Any other metals you're liking right now?
I like copper in particular, right. But I would focus, and I like palladium more than platinum, but I like platinum and palladium. But I would focus more on gold because gold will do well in a scenario where any of those other metals will do well, demand from China, etc. But it also has the ability to do well in a deflationary situation, which the other metals, of course, don't.
So let's talk mining companies now, Adrian. I love how you said it the last time, the companies had to get their act together. We saw the news about Virginia this morning. So I don't know if it's bad news or good news for the junior space, however you want to see it. But how are you seeing the mining companies right now?
Well, that's a good question. I think a lot of mining companies are taking steps, but unfortunately, a lot of the steps they're taking are the wrong steps, and they're certainly too late, and they're at the wrong time in the cycle. So what do I mean by that? Well, companies are cutting back a lot of their spending. You look at IAMGOLD, for example, that said they were cutting their G&A by, I think, 20%, but virtually 40%, but virtually eliminating their project development department. Well, wait a minute. Shouldn't we be keeping the project development section and getting rid of the, head office fat? And that's not a comment just on IAMGOLD, but it refers to a lot of them. A lot of companies, big companies, have totally scaled back their exploration, their project development, and it's only a handful of companies that are really looking at doing what mining companies should be doing in this weak market, which is taking over other companies, if they have the cash, of course, to do it. Instead of, withdrawing from the market when things are low, this is the time they should be buying things.
Right, so, okay, you agree then with Rick Rule, because I know he always says, well, look at it just as a buying opportunity, but is it just too risky right now?
Well, you look at a big company, you look at Newmont with 5 million ounces, or Barrick's an exception, of course, but you look at a big company with 4, 5, 6 million ounces a year that they're producing. That means 4, 5, 6 million ounces a year that they have to produce if they're going to stay where they are. So if you look out 4, 5, 6 years, if a company can buy good quality projects whether they're developmental projects or whether they're, exploration, like Agnico buying Caden, but they bought it fairly cheaply, very cheaply. If you can buy good quality projects, but you're looking ahead 5 or 6 years, I think it makes a lot of sense. The mistake was overpaying for marginal projects back, in 2010, 2011 at the peak. And the companies that really did that, like Newmont and Barrick, they're the ones that are paying the price today. The ones that were a little more conservative back then, like Agnico and Goldcorp, they've still got the money. They can still go out and make acquisitions, as both of them have done. And
before I let you go, Adrian, just going back to monetary policy and the Fed, I know you took part in the New Orleans Investment Conference where Greenspan was the keynote speaker, and that made a lot of headlines. And I saw different points of view of what was said and what was not said. But last night we were having a conversation about some interesting points Greenspan brought up, and I just wanted you to share it with the audience.
Well, I'm trying to think what was private and what wasn't. There were a couple of things he said. First of all, Greenspan is clearly very sharp. I mean, he's very sharp. Despite being 88 years old, his mind is still very sharp. He's very quick. He was, in my view, completely disingenuous in denying that the Fed easy money policy had any role whatsoever in enabling the credit boom that led to the credit bust, because that's just nonsense, in my view. He talked about HUD and all the HUD regulations. All that's true. He talked about the bad apples in the banking sector. Absolutely true. But if the Fed had not pursued an easy policy for so many years under Greenspan, we could not have had that credit boom because the money would not have been there to enable the boom to take place. So I think that was disingenuous. And his explanation was that, look, we had to print the money because Congress was spending all this money that they didn't have, so we had to give it to them. That's also pretty disingenuous, I think. The most astonishing thing to me, though, was when he denied that the Fed was independent. He said the Fed's never been independent. I've never said the Fed's independent, he said.
Yeah. You were surprised that wasn't made into a headline, but we weren't covering that, so maybe that's why.
You would have made it a headline.
I would have made it a headline for sure. So looking at a gold forecast, do you just see it continuing to trade in this range?
For the next few months, I think so, yeah. But again, this is the time, if you still have any money left, this is the time to be buying.
All right, fantastic. Adrian, thanks so much for your thoughts. Good seeing you in the Cayman Islands.
And you, thank you.